Alrighty, this is Andrew Bennett with insurancethatfits.com, and I am just getting the headset connected. That's why there was a little pause there at the beginning. And today I'm going to talk about universal life insurance and why I hate it. I don't think it's any good. I don't think you should get it, with one single exception, and that's, I'll go and tell you now, that's a guaranteed UL. A guaranteed UL functions very much like permanent term life. It's got a level premium. Doesn't matter what happens to the cash value, go up, down, and as long as you pay the premium, that policy is going to be there, be in effect. Okay. So that's the only type of UL I will typically write, um, is a guaranteed UL. So first, I'm going to share my screen, and I'm going to go to da, 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 da. Where is the thing I'm going to go to? Ah, here we go. So slideshow from the beginning. This is the only slide I've got. So, hey, how easy is that? Okay, so just a kind of a note on what we're seeing here. This red line right here is annual renewable term. And this is what kind of runs in the background of every term or every universal life policy. Okay. Now, this graph looks a lot different for term because terms have endings. You know, it's a 10-year term, a 15-year term, whatever. Yeah, universal life is sold to be a permanent policy, but in far too many cases, it's not a permanent policy. In fact, one of my first jobs when I became an insurance agent was going around to the company's policyholders who had bought universal life policies as permanent insurance and telling them, hey, your permanent insurance is not really permanent. It's going to end unless you plow a lot more money in. Okay. And the reason for that is this curve, this annual renewable term. As you get older, the cost of insurance goes up, and it's essentially inside the policy. It's kind of recalculated every year. So way down here at the bottom, you can see these are the lines for your premium. The scale here, they basically are look almost like they're free, but they're not. They're only a couple $100. But these, the y-axis goes up to quite a large amount. So those are premiums there. They're $3,200 or $6,400 a year. Not crazy expensive, but not exactly inexpensive either. So you can see with a UL, your cash value builds up till it peaks, and then it starts going down. And why does that happen? Because you're paying a continuous level premium, but the cost of the insurance inside the policy is going up. And so as it goes up, it eats away the cash value. The cash value goes down. And when the cash value reaches zero, the policy ends. Here it ends at, let's see, it's tough to see, but it ends at age 73. Here it ends at age 82. And you don't buy permanent life insurance so that it will go away. So this is one of the biggest things I don't like about universal life policies. Again, there's an exception for guaranteed ULs because they will stay in force no matter what happens to the cash value. Now, not too many companies sell universal life policies that are guaranteed. So you want one, you know, you can get one, make sure it's a guaranteed policy. Now, the other thing, so there are ways to use, whether it's a whole life policy or a universal life policy, to build up cash. Now, I would only do this in a couple of very specific situations. One, you've already maxed out your 401k, you've already maxed out your Roth IRA, and you need somewhere to stick some cash. Okay. In that case, I would personally look at overfunding a whole life policy over a UL, um, if you're going to do that. Otherwise, when you get your whole life policy, just kind of do the minimum you got to do to fund it. Um, the other thing is with the UL, and this is kind of a weird thing, and I'll make another video about it. but you can actually use life insurance to create a debt snowball to pay off debt. Really works best when you've got a bunch of credit cards and small debts to pay off, but it can work kind of with anything. Um, Not again something I do a whole lot of, but technically it will work. Now, so I won't explain the whole thing, but essentially, once your cash peaks out, regardless of why you were getting the policy, when your cash is at its peak, you want to cash that sucker out. You want to cancel the policy, take home all that cash, do something else with it. Whether you put it in a whole life policy, whether you put it in a multi-year guaranteed annuity, whether you put it in the market, I don't care. But don't keep it in a UL. That's my personal opinion. And anyway, so I hope it's been a little quick tutorial on why I hate Universal Life and rarely ever write it. Thank you much, folks. I hope you're having a great day and let me know what you need. Thank you.